All right, welcome everybody. It's Doug here with the LincolnList.com. I'm just going to take a couple of minutes here and talk a little bit, or maybe rant a little bit. Let's use the word rant, it'll probably fit it better, about the SPY here and the recent pullback and why I think this possibly could be a much deeper pullback than we have seen in the past. Now, before I get into that, I'm not saying that we are going to take this huge tank, and I'm not saying that, but there are a couple of things here that we want to pay attention. I'm going to show you how you can eventually figure this out with a few different moves. But there's something that's a lot different with this pullback in the SPY that we haven't seen with the rest of the pullbacks. It's like first of all, there's no doubt there's been pullbacks throughout the year. You know, when the market started, you had this nice little pullback in February, again a couple of months later in April, and then not too long ago here in August. So there's been pullbacks, and you're always going to have pullbacks in the market. The question or the thing is, you're always being bombarded. You're always being told that the market is overbought and we're due for a huge crash. There's always going to be contrarians out there that feed you that stuff, and sometimes it's correct. It's warranted, and other times it's not. Now, we've seen this market really be in an extremely bullish mode for 2 years, and what we had here was something that was very interesting that happened on Wednesday. Excuse me. If you take a look at the SPY here that I have, I'm just going to focus in on the daily chart. I'll open this up a little bit so you can see it. If we go back to the lows of February and we just draw a trend line here, the close that we had on Wednesday was the first time all year that the SPY had broken this upward trend. So each time that the SPY had pulled back, it pulled back close into the trend, or to that trend line, and it bounced. And the thing about this is the longer that, same way when you have support and resistance and trend lines, or you're dealing with technical indicators, the longer that you have to go back into time to gather that data, the more important the move generally is. Now, I use the word generally because, again, we're talking about stock market trading where anything can happen at any time, at any given moment. Especially with the market, so many things can be influenced by news. So there are things that override technical analysis. But there are so many of us that use these tools. We want to use them not as as gospel, as guarantees, but what we try to do with our technical analysis is it gives us clues what to expect. Now, we can make our shorts and our longs and we can take our risks, but we need to have the data in front of us so we can eliminate unnecessary risk, if that kind of makes any sense. So kind of getting back to the point, you've got this SPY that had finally broken a trend that has lasted pretty much all year. But if we go back even further, I want to show you a weekly chart here, because if you go back into this weekly chart, if you can go all the way back here to mid 2012 and you draw that same trend line, today it actually ended up going lower than that. So now we're just not talking about 2013, but we're going back to the very later parts of 2012 here. Pretty much when this bull market really started getting steam here at the beginning of 2013, you can see it has just religiously bounced off about the 50 moving average. So this pullback here that we've experienced, at least this time, has broken some significant trend barriers that go back not just this year, but we're looking to go back 2 years when this bull market originally started. When I think it really started, I mean, there certainly was a bull market there a year or two before, don't get me wrong, but we really started to see some serious moves in 2013 and most of this year. So you can see how far we're going back here and where we're breaching trend. Now, again, that doesn't mean that we're going to go down or we're going to collapse, but I do think we're probably going to see a couple of different moves, which I'll share with you, which is the only reason why I did this. One, if we continue to use that trend line, there's no mistaking that you're going to have people that are going to buy the dips. Algos are going to buy the dips. Traders are going to buy the dips, and hedge funds and investment houses. There's always going to be dip buyers. So having the market make a bounce in the midst of this is not something that you should be surprised. You got a little bit of a bounce today. I would say that like intraday today, it looked pretty grim. I mean, this thing was just kind of folding with no bounce. And it's like if it would have stayed down there, we could have really seen a heavy flush. But there were some nice little buys and a very impressive rally. So when you look at that, my concern would then come back up to where this trend line roughly is, which is around 195.50, somewhere in that area. that's probably, if there is a bounce, you will probably see a bounce kind of magnet itself up to that 195.50 area, to the base of this trend. It doesn't have to be to the penny, but if you kind of draw that trend line for yourself, and you could do that with any stock that you're trading. But if you kind of just walk up here, it's a good chance that it will bounce up there. Now, if it does bounce up there and it's able to consolidate or perhaps move up through there, then we could just go back to being business as usual, work our way back up to 200 and start making new highs. There's an employment report, jobs report tomorrow, so much of this could change. However, if it comes up into that trend line and it's unable to make a new high, or not, I shouldn't say a new high, or it's unable to surpass that trend, or you see heavy rejection in that area, or by any chance that it comes underneath of today's lows, which is 192.71 or somewhere in that area, then you could definitely, odds, if those two scenarios were to happen, so kind of like simplify it for you. If this bounce, or we get a great jobs number, this bounce takes hold, it goes over top of the trend line, and you have a couple of day closes over 195.50, maybe 196, then there's a good chance this market will at least try to work its way back up to the 200s. If it rejects itself off of there, and you see the rejection, you see the bounces, but they keep getting sold off in that area, or you see a low of today being taken out, perhaps there is maybe a bad job number. Not saying that's going to be the case, but maybe, let's say hypothetically that is, or it takes out the low from today, then I would say the probability would shift to newer lows where we would start looking at some other areas. The most important area would be roughly down in this 190, which was the lows back here from the last pullback. I believe it was in July, August, in this area right here. So that's where I would look to go first with. I'm not saying, again, when you have the market correction, you're not saying that the bull market would end and we're going to go into this famine period where it's going to go down to 150 and everybody's just going to be nibbling on croutons. But what you want to be able to do is you want to be able to forecast moves, or pretty much, not saying forecast moves, but you want to have plans for both directions. And I don't think traders do enough of that, is planning for both sides of the trade. Even if you're long, you kind of want to think, hey, what would a short seller be thinking? If you're short, you want to be thinking, hey, what would a long be thinking about right now? When I look at a trader, I approach it and I'm thinking about overall market conditions. I'm looking at, hey, I can't tell you tomorrow whether this market's going to go to 200 or 150. I have not a clue. But what I can tell you is if we get moves, like I said, above 196, we hold there for a few days, it could be business back to usual, bull market still intact, everything is fine. If we start moving under the lows of today, then we've got to start looking at these next couple of support areas, which would be 190 and maybe worst case scenario or some ugly case scenario, 181. So make sure that, like, when you're doing your trades throughout your career and you're building a plan, that you're looking at both sides of the trade. Try to eliminate your biases and just kind of focus on what's in front of you. Read the charts. They'll usually tell you what you need to know, or at least how you can make educated, low risk decisions. So anyway, I took a few minutes there just to kind of tell you why I think maybe, just maybe in this case, not a guarantee, but just maybe in this case, this pullback might be a little bit different than the pullbacks we've seen before. Again, you got a jobs number coming out tomorrow. That's big data. If that's hot, better than expected, then this just could blow over and it will be nothing. We'll be back to bullish kingdom again. But hey, if it's not, you have to have a plan for that too, right? You have to have a plan if it's good. You have to have a plan if it's bad. You have to have a plan A, B, and C, because trading doesn't always work out like you think it's going to, right? It's too many variables. So anyway, hope this helps you out. As always, if you have any questions, anything about trading whatsoever, you don't have to be a member of the LincolnList.com to ask me questions. Just let me share my knowledge with you. If I can help you with a trade, if I can help you learn something, if I can just save you grief and distress, then I think I've done my job. So thanks for watching this video. Take care of yourself and have a great day.